Dear members, dear treasurers, dear friends, welcome to our ATEL Summer Conference. You are watching the ATEL virtual part of our conference. However, as you know, at ATEL we have decided for more than a year to combine virtual and physical conferences to welcome a maximum of participants, whatever the form they opt for. And even after COVID and removal of the last limitation and restriction, we do believe hybrid model will be the best one to satisfy our member and participant across Europe and across Luxembourg. Therefore, welcome to both. Today's session is hosted by Hsbc. However, we have several sponsors and I wanted to thank all of them for their support. They are Arendt, Kiriba, PwC, and of course Hsbc hosting this event. Thanks for your outstanding and consistent support to ATEL and for your presentations. The program of today's conference is the following. Kiriba, together with Cash Lab, will exchange in a panel on cash flow forecasting and what is the top priority identified by corporate treasurers from the last EACT survey in April 2021. A classic but still hot topic. Then Aaron will come back on transfer pricing, which remain also an important compliance issue for a number of members and requires documentation and tools to deliver ad hoc reports. Hsbc will present a macro overview of the current economic trends, the tech themes of the moment and the innovations, and how to navigate in the low or negative interest rate environment. Here again, extremely important problem we are all facing. Eventually, in a fire chat session mode, PwC with Philip Foster, partner, and I will debate around the question, is treasury management for all? We will talk about trends and best practices which can be applied to smaller company too. As you can see, an interesting program. I hope you like it. Welcome and enjoy your conference. Now let's start with the first part with Cash Lab and Kiriba. And I'm pleased to welcome Benjamin Majard and Laurent Marcelin from Cash Lab and Timothy Simon from Kiriba to talk about the cash flow forecasting and trends on the market. Gentlemen, the floor is yours.
Hi everybody, I'm Benjamin Majard, I'm the founder of Cash Lab and I'm very pleased to host and to participate to this session on cash and working capital optimization, cash flow forecasting. To do that session, I have the chance to have Timothy Simon from Kiriba and sales manager at Kiriba. I also have the Cash Lab general manager, Laurent Marcelin, and we're going to streamline today the joint offer, the partnership between Kiriba and Cash Lab. And we have the chance at the end of this session to have a testimonial of a mid-cap company in France, a group ATEL, with a broad positioning in Europe, an international positioning with high complexity cash management setup. So starting with our solutions, I would like to hand over to Timothée to introduce Kiriba.
Okay, thank you, Benjamin. So I'm Timothée Simon. I'm working for Kiriba for a couple of years. Today I'm in charge of the mid-market. Kiriba has been founded about 15 years ago. And the philosophy and the strategy when Kiriba was created was to build a SaaS offering around security, innovations, and international to be able to provide this kind of services for centralized and decentralized treasury corporates. And today we have over 2,000 customers, including, I would say, about 1,000 in Europe, and the rest would be in the US and in Asia. We have a steady growth over 30% for the last 10 years, and today we are over 150 million turnovers. We are more than 800 staff globally. Our main R&D is in France. This is where I'm based as well, where we pilot, and we have offices in 11 countries. And this allows us to support around the clock, 365 days a year, and monitor our platform.
Just a quick comment, Timothée, sorry, because and thank you, Laurent, for letting me presenting also Cash Lab and this session. Normally, you're the one doing the talking. I'm the one today. I'm very pleased to do that. And maybe I wanted to streamline a bit about the context and why Kyriba in the context, why Cash Lab in the context, and what we have witnessed together on the market with our key clients, mid-cap clients, large-cap clients, but we really witnessed an evolution around the technology, the usage, the regulation, and for that purpose, we streamline normally what we see around three blocks. One is regulation, where we have seen this open banking trend. So in Europe, it's translating into the PSD2 standards, where the banks had to open their data to external, let's say, third-party providers, and there is a big change, big shift on the market around this use of data. Also with the spread of instant payments, where it changes how we manage the cash from a collection perspective, but also from a payouts perspective. The underlying second element is the technology, and technology allowing open banking or allowing connection between systems, ERPs or TMS. You need APIs, and APIs have been, so application programming interface is now widespread on the market, and the other aspect is what's the nature of Kyriba for 15 years now. This is a SaaS mode solution, so software as a service, such as Cash Lab is as well, and this allows the corporates to digitalize themselves. This is really an enabler around digitalization, but also an enabler around the third block, which is anything related to the pain points. I will not comment too much on machine learning and artificial intelligence, where we see that evolution on the market, where some use cases are now widespread and in finance as well, but really focus on what the customers, what the corporates wants to achieve, and this is also the testimony that we have at the end of this session. But really the clients, the corporates would like to have more what they call real-time treasury. I want to have a better view on my liquidity, so what you have at Kyriba, which is active liquidity management, and also having the possibility to widespread, to develop the cash culture and meet some requirements around reportings on treasury, and this is also on the medium-term, long-term basis what Cash Lab is offering. The COVID situation, what we are facing for over the last 12 months, has streamlined this trend and these trends, and what you see also when you had cash flow forecasting, cash management on the top of the priorities of the treasurers and CFOs, this has accelerated again since last year. So two words on Cash Lab is really to complete what you said on Kyriba, and please, and then I will hand over to you, Timothée. Is really about this expertise in the sense that the DNA of Cash Lab, with ex-CFOs like Laurent, ex-treasurers, ex-consultant, part of the team, help building a real best-of-breed solution for medium to long-term forecasting, to also allow cash flow forecasting, working capital optimization, playing around some simulation on what is needed in the next month to enable the action of the CFO, of the treasurer, of the director of controlling, etc. This is an enabler to take action, such as Kyriba, and right now Cash Lab is used by 40 plus clients in multiple countries. You see also on the screen a couple of credentials, and I think you have a great set of credentials, Timothée, to share with our.
Yes, thank you, Benjamin. I think it's very interesting what you share regarding the challenges and the context. I think the context today is really makes a lot of difference on the way our solutions are required, and the appetite for such solutions. We can see we have a lot of references. In Kyriba, we have many references around the world for, I would say, all types of companies, whether, I would say all verticals, some small caps, medium caps, very large corps, like the CAC 40 in France or Amazon or Uber in the US, for example. And what they have in common, why they want to use our platform and why they need as well your platform, I really think it's the keys today, the cash management, the cash culture is going to be more and more important. And I would say it's very standardized requirements. And I would say smaller companies will have the same requirements as the larger ones. Then in terms of solution, Kyriba, I would say it's on the screen, you can see that Kyriba in our DNA, we talk about the active liquidity network. So the way we have been created is around I would say the bank connectivity, the cash management, the payments, the secure payments. And then over the years, we have increased our offering around risk management, financial risk management, and supply chain finance. And today, we work with, I would say, best of breed solution, as you mentioned, around other topics to go further on the cash management.
No, clearly what you said is about this best of breeds setup is very important. And as you were quoting a couple of, you have incredible credentials at Kyriba, and we're pleased now to also joint credential because of the joint offer that with the partnership we built together on the basis of actually mid-cap requirements. CFOs, treasurer ask at some point, say, oh, can you have a joint offer? Can you have a joint approach? So then we have, as you said, best of breed solution to offer to and use to enhance my cash management, my cash flow forecasting, my liquidity management. The DNA, as I was saying before, of CashLab being around budget forecasting. So how can I transform an operational budget to a cash forecast? How can I then enhance this forecasting to be even more accurate, to find the right financing, to find also then the right solution for my working capital optimization. So maybe if you want, Timothée, to talk about the detail of Kyriba's solution, that would be great.
Yeah, thank you. I would say, in a nutshell, when we start, Kyriba would be, I would say, the first layer in the cash management, because we have a bank connectivity expertise. It means we have been able to connect over 500 banks around the world daily, every day to collect the statements, and it depends on the timing to secure and send some secure payments. And so it starts from there. We have all this past information and the real information because at the bank. And in Kyriba, we will consolidate it and work together with, I would say, what we call, short-term cash forecasting that could come from many different sources, and together with the historical cash. And we will see later when CashLab will bring some additional value to our customer. But in, I would say, the Kyriba core functionalities that we have around cash management or cash forecasting, we have many sources that we make available to generate some cash forecast. So the first one would be import from ERP system from our different customers. So today, most of the time, they have multiple ERP systems. So Kyriba would consolidate, I would say, for the short-term ones. They could come from transactions where you have hedging transaction or financing transactions. Kyriba has the ability to generate forecasts based on the history. So you could see what were your cash flow last year and maybe put an increase or a decrease depending on the type of cash flows. As well, because we have the bank view, we'll be able to make some comparison between what was forecasted, multiple versions of forecasts as well, with what has been the actuals at the bank. So all of this type of I would say, functionality around the daily cash management will allow all our customers to make some short-term decisions, daily decisions, to make some good balances and share the information with all, I would say, the local or the global management of the corporate regarding the cash information. I would say it would be very interesting from your side to say in the best of breed solution that we offer to our customer, where Cash Lab is really bring a lot of added value and is used together with Kyriba. I think it would be very interesting to share this part.
No, definitely, you're right. And the example of Group Capel in a few minutes will actually come to complement that and to illustrate that. As I was saying before, Cash Lab DNA is really much around a few items, few capabilities, but very strong ones. If you look at after a corporates, the first thing that you want to analyze is how they consume the cash in the past. So from a controlling perspective, how did they consume the cash? What is the working capital variation? And on that basis, actually, this is for us a first enabler, a first key analytics that allows us to prepare then the cash budget, the cash forecast. We map the underlying aspects of the controlling part of the business, and then we looked after a 12-month forecast. On that basis, then we apply what we call the treasury rules, so cash in, cash out rules. And the interesting part is, yes, we can have like a 12 months direct cash forecast, but we can also have a 12 months indirect cash forecast, so the EBITDA to cash with the working capital variation, and then the balance sheet forecast. Why this is important is these reporting statements, these forecasts are essential to anticipate your financing, to be able to identify where and when actually you need more cash than expected, potentially to launch internal actions on working capital optimization. What is also interesting is to have the ability to run some simulation. So if you play around with your numbers, your budget numbers, for instance, or if you say that tomorrow I implement a new financing solution, so let's say supply chain financing, or any type of factoring programs, you can then have that in the simulation and play around that simulation to anticipate, do the right reporting to the management. What is very important as well in this process is really when you do the forecasting somewhere, I would say this is easy. You do the forecasting, that's fine. But as you said, for the short-term forecasting with the actuals, you want to compare the actuals month by month or quarter by quarter to compare and to analyze why you consume the cash, how, if you're late in advance, but you need to analyze that on the day. And that's in the system, in Cash Lab system, you have the automation on a monthly basis when you integrate your actuals to do that. And you can manage then your key KPIs, your DSO, DPO, DIO, so anything related to working capital optimization. You can also manage anything related to your covenants. If you have some covenants, you do implement some financing, you need to measure that. You need to look at the historical data, but you also need to look at the forecasting data and anticipate, because your shareholders, your third-party providers, your financial services or bankers will like to measure that and monitor that. So the whole cockpit, as I think Group Capel will talk about the cockpits, combined with Kyriba and Cash Lab, will offer like an integrated set of solutions and KPIs and services that will allow a mid-cap client, a large-cap client to really drive that forward to manage the cash efficiently. Timothée, any aspect that you want to share also with the group?
Yes, thank you, Benjamin. I think it's very clear how our solutions are best of breeds in terms of functionalities, but also we have more than that in common. I would say in the cash culture, I think what I see, and maybe that's why as well Capel wanted to work with us, is we have the same DNA around the SaaS, the technology. As you mentioned in the context today, I think the technology, the digitalization, is really key for all the corporate, especially the mid-cap, because today we can see a lot of them that are still using Excel, and they realize that now to be more flexible, more accurate, they need to start to use some, I would say, specialized solutions like Kyriba and Cash Lab. And the way we have designed, created our solution being SaaS, allow us to support, to bring a better level of of service because it's unique version around the world, and bring a lot of innovation. Because why all the SaaS solution together are very, very successful is because we have unique version to support and a unique version to bring more innovation. So we talk about the API, for example. I think in the next 3 years, there's going to be a lot of innovation around this for all the bank credit services. And then, if we transit to the testimony from our common customer, Capel, I think it's a very good example because it's a medium-sized company, but they have a lot of growth, some international developments, so they are subject to a lot of regulations, a lot of process, and they started to change their organization. They hired a treasurer before 1 year before there was no treasurer, and then they realized they need to be able to provide some very good indicators and reports to the all different shareholders. And in this video, they will share the different challenges and how they decided to go for our both solutions, Kyriba and CashLab. And they are, once again, working together, Kyriba really for the short term and the daily decision, and CashLab more on the more strategic, longer term vision of the cash.
Thank you, Timothée. Thank you, Laurent, for this incredible joint offer that you built to meet the client requirements. And now we open up to the testimony of Groupe Capel, and we thank you for all your attention.
Le niveau d'exigence avec nos partenaires financiers nécessitait qu'on ait tous les indicateurs et tous les éléments d'un vrai TMS et que nous recherchions cette solution. À noter que c'est le président du directoire qui motivait l'ensemble des équipes financières pour ce choix. Et nous avons une informatique intégrée d'exploitation et commerciale. C'est nous qui développons nos solutions informatiques. Nous ne sommes pas sous un ERP. Donc, il était important de trouver une solution dans un contexte best of breed qui s'articule complètement avec toutes nos solutions fonctionnelles et de comptabilité.
Donc avant même la crise du Covid, on avait déjà comme projet de changer de logiciel de gestion de trésorerie suite à la croissance qu'on avait vécue. L'outil qu'on avait, c'était en fait un outil d'un groupe bancaire et on souhaitait être indépendant vis-à-vis de nos banques par rapport à notre logiciel de gestion de trésorerie. Donc, on a lancé un appel d'offres auprès de plusieurs éditeurs et la solution Kyriba, on a tout de suite eu une préférence pour cette solution. Parce qu'on souhaitait sécuriser au maximum les paiements, ajouter des contrôles en interne et centraliser les paiements pour le groupe en France. On avait au-delà de ça besoin de gagner du temps au quotidien dans la gestion de trésorerie, dans la gestion de notre cash pooling notionnel et aussi dans l'analyse, pouvoir en un clic avoir des rapports et des tableaux de bord qui puissent être utilisés et non pas devoir faire des extractions Excel avec des retraitements qui étaient ce que nous faisions avant et qui est très chronophage. Donc ça nous a permis aussi d'améliorer l'analyse du cash. Kyriba, c'était nécessaire, mais c'était pas suffisant. On avait besoin, comme Laurent expliqué, de produire des prévisions de trésorerie, qu'elles soient solides et qu'elles soient surtout consolidées au niveau du groupe. Et donc nous, à l'époque, on suivait ça sur Excel. C'était, comme j'imagine la plupart des entreprises, c'était vraiment pas suffisant. On avait besoin d'un outil fiable qui nous permette donc de consolider les prévisions de toutes nos sociétés pour pouvoir produire à nos partenaires financiers les prévisions et puis pour pouvoir nous-mêmes savoir où on allait dans cette crise en termes de cash. Donc c'est là qu'on a rencontré plusieurs éditeurs de solutions de prévision de trésorerie. On a sélectionné CashLab parce que c'est un outil qui nous permettait de consolider ces prévisions, de les affiner, de les faire vivre en fait au fur et à mesure. Chaque mois, on peut intégrer le réel comptable. Ça nous pousse aussi à accélérer le processus de clôture comptable. Ça pousse le contrôle de gestion à revoir son budget, de ne plus rester sur un budget annuel et de passer sur un rolling forecast. Voilà, ça nous permet également d'étudier tout ce qui est écart chaque mois. Donc, c'est en ça qu'on a souhaité associer en fait les deux solutions, avoir déjà une amélioration au niveau du jour le jour avec Kyriba et une amélioration en termes de prévision long terme avec CashLab.
Thanks to the three of you for your excellent and insightful and useful discussion on cash flow forecasting. Now let's move to the next topic, TP. Transfer pricing has become an even bigger issue for the Treasury Department. The latest wave of international transfer pricing guidance has an important Treasury focus. Setting interest rate, guarantee fees, and cash pooling changes now involve new consideration and documentation. To respond to these challenges, treasurers need to bring to bear additional expertise from within and outside the organization. I have the pleasure to introduce Daniel Beaton and Alain Gobel from Arendt, a law firm based in Luxembourg.
Hello everyone, and welcome to this great event. Danny and myself, we are very pleased to take again the opportunity to participate in this event. We recognize the importance of ATEL in disseminating the ideas and information on transfer pricing amongst the Treasury community. Our presentation today will be focusing on the same theme that we covered in our article in the latest Treasury magazine, which is basically the focus on, with all the new transfer pricing guidance, regulations, and so on, how much more difficult has the Treasury function become, and how should treasurers cope with this new environment? Let's kick off with our first slide, where basically we present the main themes of our intervention, and that is, first of all, firstly, transfer pricing, as you all know, has become more complex in the last years. There has been a flow of international regulation in transfer pricing, and so this has become even a bigger issue for Treasury departments. Secondly, the interest rates, remuneration for guarantees or for cash pooling has also been a lot under the focus of the OECD, and so important changes have been implemented, which rendered it even more difficult and more complex from a technical perspective, but also from a documentary perspective. And thirdly, to respond to these challenges, we have the feeling that treasurers need to bring up more know-how, maybe refer to internal and external expertise in order to cope with this new framework. Just let's take a step back and see what has actually changed so far in the last, let's say, 18 months. Well, very importantly, there have been two publications from the OECD. One is the 2020 guidance on financial transactions, which impacts directly the work of treasuries on a daily basis, as you all know. And the second is a report that the OECD has issued later last year on COVID adjustments and the effect of the pandemic on basically on transfer pricing. So as you all know, the guidance of the OECD is, as the name it says, it's guidance, so it's soft law. It has to be implemented in the legislation of each member state. There is no absolute direct implementation of the OECD guidance, but it's up to the tax authorities to see how they will apply this and what interpretation to give. And there, the first observation that one can have is the guidance is not extremely precise. So it leaves open a door to certain interpretations. And the tricky part is that a lot of tax authorities of the member states do not provide any further guidance on how they apply it, on what interpretation they would give to the different provisions. Looking to Luxembourg and the Luxembourg tax authorities, well, one has to note that the Luxembourg tax authorities have been completely silent about the interpretation or the application of those guidelines. There is no official statement, there is no circular, even communication with tax advisors or even taxpayers on how the tax authorities would implement this guidance and what possible impact could be. What we know for sure is that the tax authorities, they have a wonderful tool between their fingers, especially with the guidance on the financial transactions, to sanction transactions that they don't like or where they think there is something abusive or something that is not compliant with the arm's length principle. And what we observe is that what they do is they kind of use it in an opportunistic way. If they feel the need to use this to challenge a transaction, they will definitely do so. But there is no real consistency or coherent application or guidelines in this respect. And this makes it, of course, again, for the taxpayer and for the Treasury Department, it's extremely hard to cope with a new regulation where they don't have any official guidance whatsoever. I leave it to Danny now. I give the floor to Danny to guide you further into the impacts of these changes.
Thank you, Alan. Now let's look at the impact of these changes. Alan has identified some developments in transfer pricing which will particularly affect Luxembourg, because financial transactions are such an important part of its economy, and because the response of the Luxembourg tax administration to transfer pricing developments is not very certain. So we have a call to arms in the short term in that respect. We also think that there is a longer term need to take transfer pricing compliance in Luxembourg more seriously, which is that the new transfer pricing guidance, which Alan has explained, is itself a response to international case law in the tax courts around the world. And that case law will continue and increase. And so we expect a series of new releases on transfer pricing guidance, which will impact Luxembourg. It's not something that we can feel that we deal with now and put to one side. And we have identified 3 particular areas which we think will be affected and in which action is needed. And the first of these is more detailed legal agreements that look more like the expected contracts between unrelated parties with more detail. Second, these agreements not only should be written properly by lawyers, they also need to be ones which make best commercial sense of both parties. So the terms and conditions, as well as the price, are transfer pricing issues. And thirdly, we can't then walk away and hope that the agreements operate themselves. The agreements must be operated in the way that independent parties would do. They give the parties rights, and the parties should exercise those rights. Treasury needs to monitor that. And as a result of the changes and the uncertainty, we would recommend, outside of the technical aspects, that taxpayers consider ways of obtaining more tax certainty, either seeking an advanced pricing agreement now, or if their transfer pricing is challenged, seeking to invoke the mutual agreement procedure in tax treaties. So let's move on to the next slide to look at more detail on the first of those points. Loan agreements in particular should have loan-like features. This is a major outcome of international case law in the tax courts around the world. If a loan agreement does not look like a loan agreement, the entire loan can be treated as an equity investment, and there will be no deduction for the interest payment. For example, loan agreements are expected to have the features of a fixed repayment date, a requirement for interest to be paid, no unjustified waivers, a right to enforce payment of the principal and interest, and no limited recourse. And of course, looking at the traditional Luxembourg situation, interest-free loans and limited recourse loans have played an important role in the past. Let's move on to the next slide, which concerns our second main point. Agreements should meet the best needs of the parties. This is more of a commercial analysis. For example, loan agreements should allow the borrower to obtain the lowest interest rate, subject to its wider commercial considerations. For example, the challenge to borrowers is to explain why they didn't offer security over some of their assets, or agree to certain financial covenants in the agreement, or borrow for a shorter term, and forego any options, such as the option to prepay the loan. This requires input from parties outside of the Treasury Department. Secondly, the size of a loan or any transaction between related parties is now a transfer pricing issue. And a borrower should show that it will be able to service its loan, paying the principal and interest when due, that it needed a loan of that size, for example, to purchase an asset. And in the case, for example, of guarantees, a guarantor should be able to show that it could indeed meet the guarantee payment if requested. Let's move on to the next slide. And these are two slides on our third main point on the commercial operation of agreements, which is the most novel area. First of all, a lender or guarantee must demand payments when they are due. And if the terms and conditions of an agreement are broken, the appropriate action should be taken, except in exceptional circumstances. For example, if there are financial ratio covenants in a loan agreement and they are not adhered to, then penalty interest should be charged, the loan should be renegotiated or even terminated. And if a guarantor becomes financially unviable, then the payments to it for providing its guarantee should cease. And then moving on to the next slide, second slide on the commercial operation of agreements, it becomes very dangerous to include options in related party agreements because they must be exercised when commercially advantageous to one of the parties. For example, if a borrower tied into a long-term loan finds that it can now borrow much more cheaply because market rates have moved and it has an option to prepay without a penalty, it should do that. All of the excess interest which it claims a deduction for in the future years will otherwise be denied. And indeed, for the lender and the borrower, any foreign exchange gains or losses which arise from not exercising an option would be denied. Options also exist, perhaps, to convert the loan into equity, and those should be exercised. If other terms and conditions that would have been agreed by independent parties are broken, then the appropriate actions should similarly be taken. This is moving into a very hypothetical world where the tax administrations are now allowed to assume that you would have had a different and more commercial agreement, that it would have had certain terms and conditions. And if you haven't broken those terms and conditions that you didn't even know existed, then, well, you should have done. And you'll find yourself taxed in a very strange way. So the writing of related party agreements, especially loan agreements, needs to be reviewed fundamentally. Let's move on to the next slide, please. The new guidance and obligations which we've already described are complex and require much attention. Unfortunately, on top of them is a fourth development, which is the concept of exceptional circumstances, particularly with the relevance to the present pandemic and its temporary effect on businesses. But now as a general issue, all of the foregoing advice which we've given is tempered by the concept of exceptional circumstances, which says, yes, the parties have rights, but perhaps they shouldn't exercise them in a temporary situation. They should consider whether they will be financially better off by not exercising the right over the long term, over the term of the contract, than if they had exercised it. For example, would demanding payment of interest this month push an essentially viable borrower into bankruptcy so that there will be no future payments of interest, despite the fact that after the present pandemic restrictions, it would become very profitable again? And do the financial forecasts still show that the loan could be serviced in terms of all of the principal being repaid? So can we therefore ignore temporarily breaking of financial covenant ratios? These decisions must be very carefully documented, because the first reaction of a tax administration would be to say, your contract says this, you didn't do what the contract said. That is not commercial. We cannot accept that. To put something down on paper to contradict that argument, it has to be as strong as a contract. And the only way it can be as strong as a contract is to have a very good economic analysis of the figures to show why you acted commercially. So these changes require tighter legal analysis and more economic. Let's move on to the next slide, where I shall hand over to Alan to talk about our conclusions.
Thank you, Danny. So as a conclusion and to finish our presentation, it seems to us that Treasury departments may have to upskill in the following areas. First of all, regarding the drafting of the legal documentation, there should really be a focus to reflect the economic reality in the legal agreements, and also to include in the legal agreements all the arm's length features and leaving out everything in this respect that is not needed. Secondly, once the legal documentation has been drafted, it is extremely important also to monitor how these are then implemented in practice, so that, as the case may be, necessary action can be immediately taken. As you know, the conduct of the parties has become really important in the transfer pricing analysis. And then thirdly, add maybe economic skills and measures in order to be able to adjust to the actual, the current economic situation, especially with a view to the pandemic. Thank you very much. We are obviously pleased to be here, and if there are any questions, we will be happy to answer them.
Thanks to Alain and Daniel for this very detailed presentation. Now let's move to Hsbc triple presentation on first a macro overview of economic situation and trends with Frederic Neumann, followed by the tech themes and innovation with a panel consisting of Sia Duan, moderator, Sibel Zimagul, Vior Noran and James Croft, and eventually how to navigate in low interest rate environment with a panel consisting of Shyam Shankar as moderator, Jean-Philippe Huguet, Jonathan Curry and Raphael Zetoun. Guys, the floor is yours.
Greetings from Hong Kong. It's a pleasure to join the ATEL Summer Conference this year. And it's been a turbulent time in financial markets and across the global economy indeed. And in the last few weeks, we saw again renewed volatility when it comes to interest rates, for example, not just in the US, but really across the world. And As a result of that, foreign exchange volatility has also increased. The dollar was weakening earlier this year, and it got a bit of a bump in June. So plenty of uncertainty in financial markets. Now, one of the reasons why we have this heightened financial volatility is because of concerns around inflation. Inflation has indeed picked up, not just in the United States, but in other markets as well. And there are plenty of signs that really price pressures are climbing. Just think of the jump in commodity prices, for example. Just over the past year, we've now seen record prices being charged for some key commodities across the world. But it's not just that, it's also supply chains have been struggling to keep up with very strong demand. We've seen demand for goods rise very sharply over the past year, and we have seen factories struggling to keep up with that, and even some of the logistics networks have started to creak, if you will. We see, for example, record shipping costs now from some key routes, whether it's from China to Europe or China to the United States. And then also we see signs that consumer prices are picking up. In the US, for example, headline consumer prices rising around 5% year over year. That's a very strong pickup. And we see even in parts of Europe, for example, consumer prices starting to pick up as well. So it's not surprising that financial markets are concerned about inflation, and that is really the heart of the financial volatility that we have seen. But from our perspective, much of that is actually increasingly in the price. And because we don't really worry about sustained price pressures coming through over the next 6, 12 months or so, we think this is really a transitory phenomenon in many ways. For example, the increase in price pressures on the consumer level is really mostly concentrated in the United States, and the US is unique in some ways because the US government has transferred enormous amounts of spending power to households over the past year, and that means consumers are cashed up, ready to spend just as the economy reopens. But that's not really true in other parts of the world, perhaps in Europe to some degree. But if you look at Asia, for example, households have never received that big check in the mail. And so, yes, the economies are reopened in parts of Asia, but there's not this pent-up spending demand that's coming through, and hence consumer prices aren't really increasing at the same pace. The other thing we shouldn't forget is that the labor market still need a long way to fully heal. And at the end of the day, to generate sustained inflation, you really need wage growth to pick up. Now, a lot of people point to very low unemployment rates in the US. In relative terms, at least, the unemployment rate officially is now at 5.8% or thereabouts. But that's really a bit of a statistical mirage. In fact, if you adjust the US unemployment rate for the participation rate and assume that about the same number of workers come back to the labor force as we had in January of last year, then the actual unemployment rate is more like 8.5%. And that's not far from the depth of the global financial crisis. And just remember how long it took to really rebuild those jobs that we had lost during that particular crisis. And that's also something we observe in other parts of the world, that in the initial phases of reopening, yes, a lot of jobs are being created, but then that quickly slows down. China is a good example, and China has been out of this pandemic really domestically for a year or so, but even there, the labor market remains fairly soft. Wage pressures aren't rising too much, so that consumers don't really face rising cost pressures when they go out for the grocery shopping. And so the labor market, again, across the world will likely anchor inflation for quite some time. The other thing to remember is the rise in commodity prices, which is so concerning for the markets. Really, that is driven in large part by China. But what we see in the Chinese economy is actually a gradual deceleration in the last few months, and that will intensify over the second half of the year. And if the Chinese economy cools down, that usually tends to then reduce price pressures on commodities, because after all, China demands well more than 50% of most of the world's major commodities, from nickel to iron ore to coal. All of that's being consumed in China. Now, the Chinese policymakers have, in fact, started to tighten monetary policy at the margin. One indicator we like to look at is the credit impulse, which is the new amount of credit that's being pumped into the economy, new bank loans, for example, new bond issuance, relative to the size of the economy. And that has actually turned negative in the last couple of months. And that's a good leading indicator for where growth will go in China, and particularly in the construction sector. We'll likely see a deceleration of activity over the second half of the year, which should help to really bring down some of the froth that we've seen in commodity markets. So if you put all of this together, the weak employment markets in many parts of the world, the temporary supply chain disruptions that we're seeing that will likely ease as kind of production comes back to normal, and the fact that the Chinese economy is cooling at the margin, we think that really we're looking at transitory inflation. And that means that the Federal Reserve will not be in a hurry to hike interest rates. The first interest rate hike only coming through in 2023. Now, the Fed will taper its asset purchases probably at the end of this year, but it will take a long time until the taper process is completed. And even a year from now, the Federal Reserve will still be buying bonds and markets. So what does this mean for interest rates? Well, we think actually US interest rates in particular will drift down again over the second half of the year. The 10-year yield, the US government 10-year yield drifting down possibly as low as 1% by the end of this year. And that also means that the temporary dollar strength that we've seen in recent weeks as a result of the uncertainty around Fed policy, that should fade as well. And we begin to see again a weaker US dollar over the second half of the year. Now, we should also highlight that even though the outlook for economic growth is not perhaps quite as frothy and generates inflation as many people would argue, there's still a lot of positives going on. We are recovering from the pandemic. We are seeing increased rollout of vaccines, not just in the US and Europe and developed markets, but increasingly in China as well, which just hit its 1 billion mark in terms of the number of people that have been vaccinated. China vaccinates about 17 to 18 million people every single day. So that is certainly a rate at which we can vaccinate quite a lot of people. And that will mean that the pandemic will really move into a rear view mirror as we roll out these vaccines across emerging markets as well. And that should lead to stabilizing, improving growth over the course of next year. And there are also a number of other positives to consider. For example, the pandemic itself might have actually accelerated productivity gains. Just think of the digitization that we're witnessing in so many walks of life over the past year. That will continue, and that will lead to productivity gains over the coming years. In addition to that, we also think that companies will invest more. One big theme for the coming year is really a spike in CapEx investment by many companies, particularly in emerging markets and East Asia. And when we get these new waves of CapEx spending, investment in factories, automation, for example, that tends to drive productivity as well. And then don't forget that the US-China rivalry, as much of a headwind that is for some markets, for some economies, it also in the medium term really drives innovation, because we see governments around the world, China in particular, but possibly now the US as well, investing more dollars into innovation that will ultimately benefit economic growth as well. So you put all of this together, it really paints a picture of gradually improving economic growth, not with too much inflation coming through, which would keep interest rates anchored, and possibly a slightly weaker dollar. But the increase in productivity that we will see over the coming 2 to 3 years will also contribute to the fact that price pressures will remain manageable, and therefore we'll look at a fairly smooth and inflation-less recovery in the coming year or so. So with that, I want to thank you for your attention and wish you a successful conference. Thank you very much.
Good afternoon, everyone, and welcome to the Hsbc panel, Tech Themes in Treasury. This is Sija from Global Liquidity and Cash Management, Hsbc Luxembourg. Today, I'm joined by my colleagues, Sibo, James, and Vibo, and we will discuss about digitalization and fintechs in trade finance, APIs, and next generation virtual accounts in cash management. So without further ado, let me start the first question to you, Sibo. We know a lot of focus has been on digitalizing trade and blockchain, unlocking working capital, and enabling more trade. So what does charting a path to trade digitalization entails?
Yes, absolutely. I think the last 18 months has been incredible for all of us, I think banks and corporates. Trade digitization acquired a new urgency as a result of COVID-19, and the future state of end-to-end paperless trade is now closer than ever. So the digital transformation is building on technologies and collaboration, leading to a more sustainable, resilient future for global trade. We're now seeing the convergence of new technologies such as artificial intelligence, supercomputing, 3D printing, and Internet of Things. There's absolutely a change of behavior and mindset about corporates, and this is very critical. The efficiency gains from automating trade finance processes are enormous. This is reflected in terms of labor, cost, and speed. So one of the most promising developments in this respect is blockchain technology. Blockchain-based platforms such as Contour for mainly documentary credits and WeDoTrade for open account bring together the banks, corporates, and ecosystem partners on a common digital and trusted network. They're already transforming the global trade. The documentary letter of credit transactions carried out by Hsbc on Contour have reduced the processing times from 10 days to under 24 hours. This is incredible kind of an improvement in the journey and helps with unlocking working capital and enabling more trade to be done between countries. So bringing the decentralized digital trade finance platform into the full live production, Contour has now completed beta testing and commercial proposition went live in January 2021. Owned by 8 shareholder banks, including Hsbc, Contour delivers a global network for trade finance over distributed ledger, allowing parties to transact and view information securely. So the legal, I just want to very briefly kind of talk about the legal aspect because that's critical. So rather than having to string together 4 or 5 different legal agreements between the buyer, seller, buyer's bank, seller's bank, we now have a rule book, which makes it very easy for everybody to sign up and know their roles and responsibilities. This rulebook runs alongside the tried and tested ICC Uniform Customs and Practices, UCP, used for documentary credits. We're proud to be leading the charge in this space and working closer to expand the Contour offering beyond letters of credit to guarantees and structured trade products. Thank you.
Thanks. Then how would you describe the role of fintechs to make the trade easier for corporates? And how is Hsbc engaging with them?
It has become very clear to all of us is if we're going to succeed in digitizing trade, it has to be an ecosystem type of working way. So co-creating bank agnostic solutions with clients, fintechs and third parties, we have to make trade easier for corporates. Those fintechs are very agile, right? They have scalable tech, but they may not have the customer base or the scale of operations like the bank. So there's kind of clearly an area for collaboration there. The winners will be those banks who will utilize strategic partnerships with fintechs within the wider ecosystem, so including logistics, insurance, and customs to mutual benefit and scale. Banks also have to become more agile and deliver value efficiently. I'll talk about it a bit later, but HSBC has recently co-created a fintech solution on a supplier instant pay program, leveraging data-driven predictive algorithms to quantify supplier performance risk, which was a first in this area for all of us. So there's key collaborative areas progressing with fintechs.
Thank you. So James, we know that APIs can be a bit of daunting concept. Can you just help us to understand in simple terms what they are?
Certainly. API stands for Application Program Interface, and they're used in everyday life. If we just take this at a very high level, I like to use a waiter analogy. So when we go to a restaurant, we sit down, a waiter will come over and he will take our order. The waiter then takes that order to the kitchen where the chef prepares the meal. The waiter then brings that order back to the table and we all enjoy a nice meal. So in that instance, the waiter is the API. So if we look at banking in terms of APIs, what the API enables us to do is connect directly with our customers' systems. So we connect HSBC systems with our customer systems, and the API allows for the real-time transference of data between HSBC and the customer, and between the customer and HSBC.
Thanks. So what's the benefit of using APIs over traditional like host-to-host or SwiftNet-based connectivity?
Okay, so with the move now to real-time payments, this results in a more real-time demand and interactive access from our customers to their bank accounts. So using the traditional host-to-host and SwiftNet kind of based connectivity, treasurers cannot always monitor increasingly dynamic account activity or make real-time necessary liquidity decisions. What the API connectivity will allow treasurers to check is their balance and transactional information in real time and on demand, and it avoids the reliance on the more traditional reports and statements. So it will allow treasurers to create a more flexible and dynamic workflow and make more dynamic cash management decisions.
Okay. So how long does it take to implement API connectivity?
Okay, the implementation period largely depends on the customer's own infrastructure and how ready they are to connect and consume APIs. Our record currently is 6 days, and that's from the initial kickoff meeting with the client to actually going live with the solution. We do have to bear in mind, though, that client was particularly tech savvy. A more typical implementation period would usually be between 6 to 8 weeks.
So if our corporate is already using Kyriba as their TMS vendor, do our APIs connect with it?
Yeah, so our APIs are written using an industry standard ISO 20022 message format. So they're compatible with all systems that use that standard. We're working with a number of leading TMS providers at the moment to accelerate the technical integration of our APIs with their platforms and provide a more plug and play experience to the customer in terms of the integration. We are currently working directly with Kyriba to test the integration and hope to begin helping our mutual customers connect to HSBC APIs towards mid-year.
Thanks. So Vibo, can you tell us how virtual accounts in cash management have evolved from being just a simple reconciliation tool to an important element for treasury transformation?
Sure. Virtual accounts as a concept is in the industry for a long time now. The historical concepts of virtual accounts are basically connected with one single product and used to support the reconciliation of the customer by issuing a series of multiple virtual IBANs. This concept over the years have grown from just a simple reconciliation tool for a singular entity customer, a singular account customer, to a multi-entity and a multi-currency concept. Today, virtual accounts can not only receive funds, but they can also transfer funds. So when I say transfer funds, so it's virtual accounts will only hold the ledger information. It's important to note that the underlying physical account will be the parking lot for cash, and they will hold the funds actually. With the virtual account structures, corporates can introduce their multiple entities, a participating legal entity. So that means that they can reduce the number of physical or the real bank accounts, which actually cost them quite a lot, not just in terms of bank charges, but also in terms of reconciliation and the amount of effort which is running behind maintaining such a large structure. Also now with HSBC, the virtual accounts have gone to the next level, and we call them as next generation of virtual accounts, where customers will not only have the benefit of multiple entity and the multiple currency virtual accounts, but also we can see virtual accounts in multiple countries in one single screen. Also to the other part of the question, that how it has become the important element for treasury transformation. This is the era of big data. Now, ERP systems need much more data to process complex reconciliations or cash flow forecasting algorithms. This is where the virtual accounts will add tremendous value. This also works well if the corporates have multiple instances of ERP systems, which I see quite a lot in the market, and they can outsource all activities to combine the data in a virtual structure in a bank. They can download and process the data in multiple ways. Also, sometimes corporates cannot or may not have all the instances or modules of the ERP systems. I'm talking typically of the smaller corporates in the small and medium enterprise segments. Virtual accounts can be a cheaper alternative where they can actually segregate their data in a much more meaningful way. They can literally bring in hundreds and thousands of virtual accounts in a structure and can slice and dice the information in a much more meaningful way. And this is basically like a treasurer standing in front of a whiteboard and drawing a most aspirational structure which works the best for him or her. And that's where the virtual accounts can add value. So it will not be wrong that virtual accounts do provide cheaper alternatives to products like notional pooling and TMS systems as a whole. Thanks.
Thank you. What are some of the key features of HSBC next generation virtual accounts? And can you share with us a real client example?
Yeah, sure. There's a fantastic self-service user interface which HSBC has launched last year, which can help actually the customers manage their own cash management virtual account structures with minimal intervention needed from the service teams of HSBC. They can control who sees what at their end, create and modify virtual account structures, create their own reports, and customize them for their own reconciliation systems. The other important feature which HSBC provides is the virtual accounts report. Now, these reports are customizable, but also can integrate with the client's ERP systems very quickly, because these reports are generated from the same source as the real bank accounts, which I believe most of the banks are not able to crack still. So that means the onboarding time of the virtual accounts really reduces to just few days. And also we have got a very unique interest calculation capability at the virtual account that goes extremely well in terms of a multiple entity, multinational corporates, which has got intercompany interest calculations in a multiple entity structures. And since everyone knows that the HSBC has a global footprint, we can simultaneously create virtual structures in multiple countries. Now, in terms of a corporate case, we had a large corporate who has got around 100 plus accounts scattered across multiple different locations. These accounts, their liquidity was trapped and their working capital was under a bit of a strain. They were incurring a lot of fees, banking charges when it comes to transferring money within those bank accounts. And also they were actually incurring quite a lot of charges when it comes to multiple instances of their own ERP systems. So what we have done is we have transformed the whole structure, and the accounts have been reduced from 100 plus to around 10 to 12 virtual physical accounts, and then multiple virtual accounts underneath. The overall cost element has come down drastically. The customer do not have to pay HSBC or any bank the charges incurred in moving the funds between those physical accounts, because now it is all virtual, and virtual to virtual account is just free of cost. And also they are saving significant amount of money in terms of reporting and reconciliations. Thank you.
Thanks. Is HSBC offering next generation virtual account in Luxembourg?
Yes, we are currently offering the product in Netherlands, Ireland, Channel Islands, Isle of Man, and UK. We are launching the product in Luxembourg in Q1 2022 with the virtual IBANs of the Lux IBANs. But we have already started deep dive discussions with corporates in Luxembourg because of a lot of interest from corporate treasurers, and the decision-making process here generally takes a little bit of time before actual implementation. There are so many different aspects that needs to be seen. So it's important that if someone is interested, so please don't hesitate to contact myself or the sales contacts in HSBC Luxembourg. And if you are interested in more information about the virtual account, and the demo is really exciting of the HSBC Next Gen virtual account, so we can take you through that.
Thank you. Thanks a lot for these interesting insights. So we invite anyone in the audience to contact us for question or more information on HSBC offering. So before closing the session today, can I ask each of our panelists to share with us a final message or a key takeaway? So Viper, please.
Yeah, thanks. So virtual accounts, as I said earlier, no doubt has evolved themselves as a multi-dimensional utility product that appeals to a wide section of customer segments, from very, very large corporates to a small, medium enterprise customer, because of massive cost advantage and the flexibility it provides. While technically the product has taken big strides in the industry, but regulations have still not yet caught up with the innovation. There is no mention of virtual accounts in any regulatory rule books yet, which means that the true potential of this product is still to be unleashed. And I'm sure that the virtual accounts will change the face of cash management forever.
Here at HSBC, we recognise the demand for real-time access to our global liquidity and cash management services, and have developed a suite of Treasury APIs to support our customers through their own digital transformation. In delivering real-time connectivity between the bank and the corporate, our APIs offer the connectivity to instantly access financial account data and initiate payment instructions securely between our corporate treasury systems and the bank's global network. Data flows with unprecedented speed, providing greater detail and transparency that enables the evolution of most day-to-day treasury activities. With more information, something as fundamental as reconciliations and payment exceptions management can be enhanced, saving time and money.
At the end of the day, I think we need to kind of acknowledge that to help corporates to digitize their trade processes is by meeting them where they are. So this is kind of a new and evolving area, and I think this is also relevant to the market in Luxembourg, with some of the key global players are present as well. So what corporates are expecting from us now is fully digital experience from onboarding to KYC and servicing. So we can do this by putting banking solutions to when and where clients trade in the digital environment. So the best example of this is, for example, e-commerce. So if a client is involved in e-commerce, we can link there the APIs that James have been kind of covering through that kind of an API connectivity, and we can support the buyers and sellers in that journey as they would need financing for that transaction. One global example of this is HSBC's recent partnership with Hong Kong-based online shopping and entertainment platform to provide a new digital trade finance solution to e-commerce sellers. The collaboration enables vendors. These vendors are electronic appliance sellers, they can be fashion retailers, they can be consumer goods providers, so it's kind of across wide sectors, to access financing and funding without having to present paper documents. So corporates are looking at what we can change their business today by leveraging the digital solutions that are available to them. And banks must co-create with them to ensure that they can take advantage of what's on offer. Thank you.
Thank you. Thank you very much. Thanks.
Hello, everyone. Welcome to the HSBC panel discussion on tools to navigate a low-rate environment. My name is Shyam Shankar, and I run the multinationals team here at HSBC Luxembourg. And to discuss this very interesting topic, we have with us today a panel consisting of 3 eminent experts from global markets, from HSBC Asset Management, and client coverage. We are going through a unique extended period of low-rate environment, as many of you know. And despite a steady news flow around inflation, especially over the last few days, HSBC forecasts that Fed is not expected to change interest rate until end of 2022. Now, there are various factors that the research team have taken into consideration for these forecasts on the policy rates, which you're welcome to visit through our research website. But as such, the purpose of this session is not to discuss the timing of the rate rise, but to understand what are some of the tools available to the treasurers to navigate such an environment. And as such, it's worth keeping in mind that the principles discussed here are applicable not only to a low-rate environment, but also to other scenarios in the future. It's really about defining a corporate's risk appetite and sticking to it. So maybe starting with you, Jean-Philippe, as a head of multinational corporates and someone who speaks to clients on a daily basis, what are your key thoughts on this topic? And based on what you're seeing, what are some of the tools available to the treasurers today?
Thank you, Shyam, for the question. I think first we need to take a step back, and the first piece, I think, of the puzzle is to determine how much liquidity the business really needs. So I think getting the day-to-day requirements should not be difficult. Treasurers can plan ahead by staying close to the business in order to understand the market forces at play, conducting the detailed risk assessments, and centralizing cash as much as possible. And banks, including Hsbc, can help, and we have developed cash forecasting solutions for that purpose. But I think the challenge resides really in the size of the unexpected requirements. And these requirements can be determined by internal factors, such as M&A, dividends, share buybacks, but also external ones. And we have plenty of examples over the past months. So we use usually a simple way to divide the cash into 4 categories. By segregating the cash and liquidity into these 4 areas, you can decide which targets and which parameters you want to assign to each of them. In general, treasurers want to explore investment solutions to secure some return on capital. However, what we have learned during the past crisis is that while the return on capital is important, the return of capital is critical. So from my perspective, security is first and foremost, then liquidity and yield come. But you can decide to weigh these 3 elements differently depending on which bucket your liquidity is in. So there is a wide range of products available for treasurers to invest their liquidity. I would broadly group them into 3 categories. A common option is to place the excess liquidity with banks. This gives you the necessary flexibility, but you have to analyze the counterparty risk. Also, the issue treasurers face, particularly with currencies with a negative rate, is that financial institutions might want to pass this to corporates. But by centralizing cash with a header account of the cash pool, you can discuss with banks to find ways to use liquidity management products. Centralizing also means you can combine negative and positive rate currencies, which will be more appealing to financial institutions. Finally, remember that banks prefer long-term liquidity versus short-term one, as the latter has an impact on their own balance sheet, particularly through the liquidity coverage ratio. The second category is structured products, and this includes structured notes, dual currency investments, and much more. And we see more and more clients looking into these products. Bigger investment pools often requires greater diversification, but this requires to update and sometimes broaden your investment policy. And I would really encourage you to challenge investment policies that are not fit for purpose anymore, and we can help with that. And finally, the last one is asset management. Asset management products are off balance sheet from a bank perspective, and this category offers new opportunities to benefit from asset diversification, but also to play an active role in some other topics like the ESG.
Thank you, JP, for that overview. Maybe coming to you, Raphael, now. You have a lot of conversations with clients around structured notes, structured solutions. Do you see an increasing interest around structured yield enhancement products from clients? Can you give an overview?
Yes, definitely, and thanks for the question, Shyam. I just come back on what JP has just said, where cash segmentation is really important those days. And we are talking to treasurers now in continental Europe in order to define a benchmark for them, which means that how much cash did you when Lehman collapsed? How much cash did you need back in 2012 and 13 when there were the European sovereign debt crisis? Those are the moments which should define how much cash do you need as a business. So let's say you now hold 2x of cash, and during those benchmark times, you only needed 1x of cash for your day-to-day activities. Then if you continue to put your additional X cash into money markets, deposits, or into your current account, which are now in negative or at best 0% yield, then you are losing money for your company. And that's where structured notes comes in. We now have volatility which is high through the pandemic and its future effects. So what you did as a treasurer was to build a wall of liquidity in order to cope with the uncertainty. And now that we have that liquidity available, we have that excess liquidity, we can simply invest them in negative to 0% territory if we don't think smartly about how to use that cash. And that's when structured notes comes in.
Thank you, Raphael. You touch upon a lot of interesting points there, and I'm sure each of those points can be the topic of another seminar. But maybe quickly picking on one particular product which seems to be gaining in popularity, dual currency investment. Is that a product that you talk to clients often about? And what are some of the key features of this product? And perhaps more importantly, what type of corporate might benefit from such a product?
Yes, definitely. I mean, dual currency deposits are famous those days because of the combination of facts that I just mentioned before, but also and probably above all, because they are simple products. A dual currency deposit is nothing else than a normal deposit combined with the sale of an FX option. So what happens is if you have euro cash available, you would make a deposit in euro, and at the same time you would sell a euro call facing a currency where you have exposure on. And the premium that you should have received by selling that option would come to boost your deposit, right? That's what a dual currency deposit is. And Hsbc has capacities to work with you depending on your risk profile, depending on the currencies of exposure that you have, depending on your timing to maturity. We have capacity to define with you exactly the option that you would want to sell. Let me just give you an example. Let's say you are a continental Europe corporate and you have to pay your suppliers in China in renminbi in 3 months' time. What happens is you can make a dual currency deposit by depositing your euros to a bank and at the same time selling a euro call renminbi put to boost that deposit. What happens then in 3 months' time is if renminbi has depreciated, then you would get reimbursed on the dual currency deposit in renminbi. So that's when your cash is at risk but at the same time, the goods that you have to purchase from China are going to be cheaper because renminbi has depreciated. On the other way, if renminbi has appreciated, then you would benefit from a boosted deposit because we would reimburse your dual currency deposit in euro with the boosted yields. But at the same time, your goods are going to get more expensive in China.
Thank you, Rafael. Yeah, very interesting points. And because of the lack of time, we cannot explore this further at this stage. But like you say, I'm sure we can organize more calls as needed. Maybe coming quickly to Jonathan, who's representing HSBC Asset Management here. Corporates, Jonathan, have historically always looked at money market funds for investments. I mean, we are going through a period, like I was mentioning earlier, where you have a lot of liquidity in the market. What do you think is changing given that particular backdrop? Do you think corporates are looking at longer duration funds?
Let me take your second question first. I think definitely we are seeing an interest in longer duration funds. We've seen it already, but I think it's continuing as we continue through this period of either negative rates or ultra low rates, depending on the currency. So it's definitely a trend that we've seen. There are different options available, from an asset management perspective, but there are a number of considerations I think investors need to be very thoughtful about when looking at longer duration funds. So firstly, how much to allocate to these type of solutions. To the points that Jean-Philippe made and Raphael, it's very important that investors think about what an appropriate allocation is to a longer duration investment, because the intention of those investments should be to hold them for a longer period of time. Unlike, say, a money market fund or a very short-term deposit. Really understanding the investment process that the asset manager applies to manage the risks inherent in a longer duration solution. That they are less homogeneity of offerings in this area, say, compared to a money market fund or a very simple bank deposit. So it's really critical that the investors understand the investment process that the asset manager applies and that they trust that investment process. Really getting comfortable with an increase in return volatility. That's not something that if an investor's used to a deposit or a money market fund, return volatility in terms of capital return volatility is not something that's inherent in those solutions. But it obviously can be in a longer duration solution. So getting comfortable, understanding what the risk appetite is of the Treasury team, understanding what the risk appetite is of the board for potential negative returns over a month, over a quarter, and also a general increase in return volatility. It's important that the investor really has an understanding of the type of risks that they want to take. So with a money market fund, that risk profile is really decided for you by the fund. Whereas in many of the ultra short duration solutions, which can be in separately managed accounts rather than a fund, the investor needs to have a view which the asset manager can help with in terms of defining the risk profile that they're willing to take in a longer duration solution. And finally, thinking about the internal approval process. This can be, for some investors, it can be a longer process, particularly if this is a newer type of solution that an investor's looking into. So thinking about how to get that approval through, and again, looking to the asset manager who can help support that process.
Thank you, Jonathan. Again, a very large topic on its own right. I'm sure there is lots to discuss in separate calls. Maybe switching gears a little bit, I wanted to come to ESG, which clearly is a word that you cannot escape, and it's taking off across various banking products, right? But what I wanted to get your views on today is more on what you would call on the liability side, the possibilities of ESG. So what I mean by that is, when it comes to bonds or when it comes to RCFs, sustainability-linked solutions clearly are becoming more and more popular, and it's getting a lot of attention. However, what perhaps people may not realize is, also on managing excess cash, excess liquidity, there are solutions now available for someone like a treasurer looking to find solutions with ESG. So maybe I start with you, Jonathan. On asset management side, can you give us a short overview on the possibilities from an ESG perspective?
I mean, I certainly agree with you that the focus, very much the focus today has been on thinking about sustainability on the funding side for corporates. But we are definitely seeing increased interest on thinking about how a treasurer, when investing cash, can support their business's wider sustainability goals in the same way that they've been doing that around the funding side. So it's definitely an area of increased interest to help support those objectives. The strategy that we have, that we've developed, is a very differentiated one. I think what's really critical here is that, again, credibility in the investment process is really critical. I think one of the key considerations for any investor in this space, whether it be on the investing side or the funding side, is this solution really going to have a genuine benefit to the business's sustainability objectives and to the wider society, which for any investor who's investing in an ESG solution, that clearly has to be one of the reasons why they're doing it. And the solution that we've developed, we believe certainly has that credibility. It has the engagement element with issuers, where we're trying to encourage issuers in the money markets who perhaps have been less successful in managing ESG risks in their businesses to change based on the weight of money that our clients are putting into ESG solutions. And that's, I think, again, something really critical for us. So as with my comments around longer duration solutions for cash, some of those are as applicable in the ESG space. So the homogeneity point is as relevant here as it is in the longer duration space. There is less homogeneity in terms of solutions. So really looking under the hood, really understanding the investment process, the credibility of that has to be the most important consideration, in my view, for investors looking at this space.
JP, I mean, do you really see a renewed interest from an ESG perspective in your client conversations?
Yeah, thanks, Shyam. Listen, I mean, treasurers have an increasing strategic role within the organization, and ESG is becoming more and more strategic and important. So what I've seen in general is that European companies and treasury teams take a more proactive stance on this topic. And clearly, I would say in general, European companies are leading the market. That being said, I think other regions are closing the gap pretty quickly, particularly true for US corporates. So I strongly really believe that, the treasurers in Europe, and particularly in Luxembourg, have a really, really critical role to play in the development of ESG. And as one of the largest banks in Europe, and because we have engaged on the ESG topic from the beginning, from the outset, we have been extremely active in co-creating new products for our customers. Jonathan and Raphael mentioned some of them. I will mention another one. We offer green deposits in selected markets and currencies. But more generally speaking, I'm absolutely convinced that investable cash represents a low-hanging fruit for treasurers to play an active role in the ESG agenda, both internally within the organization, but also externally.
If I can conclude by reiterating some of the key points that we discussed, right? So review of treasury policy is a critical starting point, given the sort of circumstance that we are facing. Forming a view of cash across core, strategic, and reserve can be helpful. And lastly, there are solutions available across, what you could say 3 buckets, on a bank's balance sheet, structured notes, or off balance sheet through funds and asset management products. And ESG is becoming increasingly important and something that can be applied across all three buckets. So thanks a lot for your time, and thank you everyone from the corporate treasurer space for listening in. Obviously, HSBC is available to help on any of these topics as needed. Thank you.
Thanks a lot to HSBC team, I would say a football team, for these presentations. The last part consists of a fire chat session that I have the pleasure to introduce with Philippe Foster from PwC Luxembourg on an important question, is treasury management for all type of company I mean, and what are the trends identified in the market? Let's start now. Welcome to this panel. Today we have the pleasure to invite Philippe Foster, Director at PwC Luxembourg. And with Philippe we will talk about the Treasury for all. Is Treasury really dedicated for all type of company? When do you need Treasury management and a real organization of your Treasury? That's the key question we'd like to answer. And also to talk about the evolution of our profession, our function, especially in light of the recent health crisis. So Philippe, welcome. Thanks for being tonight with us. First question, is Treasury really for all?
Yeah, well, first of all, thanks for inviting me. I'm really happy to be here, and well, obviously virtually, but it's still a pleasure. Let's directly step in. And well, yes, Treasury is for all. And I would say it otherwise. I think Treasury is not dedicated to big corporates. So I think it's clear for everybody. Everybody faced Treasury issues during the crisis, right? So I think the crisis, and I would say the best way to say it is potentially to refer to the press and says what we can read today is the crisis shows the importance of liquidity management, cash management, and I would say Treasury as a whole. What is surprising is 10 years ago, if you read the press, you have the exact same title. And even more surprising is 20 years ago, you had exactly the same title. Each time we have a crisis, each time we realize Treasury is really important. But then obviously we have big corporates, we have treasurers which are really well equipped and really professional. But we have as well other type of clients or other type of corporate entities in Luxembourg. And just to give a few examples, I was discussing with some real estate guys recently, and the issue they face is when they have to pay for something, they need 6 tokens because nothing is automated and it takes ages. And I'm not talking about how many times they need just to get the information on global cash. Another example, maybe just to show that it's really for everybody, is in private equity. It's not rare to see one entity of the group being forced to pay something because there is not anymore enough liquidity, I would say, the entity who was supposed to pay. And all in all, I say, for 30 years, we're seeing the same thing. I mean, Treasury is important, but we're still facing those situations. So yes, I think Treasury is really for everybody. I think whatever the size, everybody is sharing the same issues, and obviously the answer will be different. So maybe first of all, do you share the same view as the chairman of the association?
I totally agree. So Treasury management is for all. Everyone should manage a Treasury, providing they have a minimum size, of course, for the SME until the large multinational companies. The level of maturity, the level of tools and let's say FTEs could vary from company to company, but I totally agree with you. Yeah,
indeed. And I think maybe just to complement this, if we look at the evolution of priorities of the agenda of the treasurer, and here we're talking about 2017, 2019, this comes from the PwC survey, but 2021 we used the ACT survey. And what we can see is cash flow forecasting is always ranked #1. And I think this is very valid for big corporates, but as well for small entities, for private equity, real estate, and whatever the size, whatever the industry, I would say. Now, obviously, everybody knows that cash flow forecasting is a priority. Why? Because you have a lot of data to digest to be able to prepare a kind of robust reporting. You have a lot of interaction to interact with the business, with the banks, and so on and so on. So I do understand why it is still, I would say, on top of the agenda, but I think with the new solutions we have today to tackle that old problem, we should find solution.
Yeah.
So
no, but I totally agree with you. If we take the EACT annual survey, the PwC global survey, the risk remains the same. The order could vary from year to year, but all in it's quasi the same risk. Maybe for smaller companies, digitization of treasury, it's less an issue, although, and it will be a topic we will address, it's emerging. But I fully agree with you. So the topics, whatever your size, seems to be the same year on year. And so it just means that, to answer the first question, yes, treasury is really for all.
It's really for, yeah, exactly. And I think if we just talk about FX risk management, obviously it's here for everybody. I mean, as soon as you have foreign operation, you can have impact on your margin. And we all know that we face pressure on margin.
Yeah.
So this is a key topic. Now maybe back on digitalization. I think it's a priority. It's not necessarily an issue. And it should be a priority for everybody because it's part of the solution. And obviously, we are not asking everybody, or we are not telling everybody to say, you need to go on Treasury on demand, you need to be virtual and everything and so on. I think if we talk to a small or medium entity, the idea is more to say, stop using 10 tokens. Maybe you can use the cheap solution. I think, you have license for 20K per year and you can have forecasting tools. Yeah. So even banks propose free tools, free solution. So I think technology should really be considered. That's more.
Get rid of your Excel, go to dedicated tools.
Yeah, I mean, Excel is robust. I mean, in the sense that, since years we're saying Excel should disappear, Excel is still there. I have sympathy for the fact that we should avoid spreadsheet because there is a risk, operational risk mainly. But I think, if we talk to a smaller entity, Excel can be a fantastic tool. The idea is how you feed your Excel spreadsheet, and then you can use technology.
But don't you think that the good news, technology also progressed a lot, maybe faster than our profession? So I have the impression that today we have solutions at our disposal that are cheaper, easier to access, maybe with new technology, so easier to implement. And that's the good news for smaller entities, not only corporates, by the way, it could be family offices, holding companies, private equities, fund servicers. And I think that these solutions are more accessible than they were and easier to implement.
Well,
do you agree?
Totally. No, I do agree. And I think we need to pay attention to when we talk about technology, we are not talking about one big tool that can cost billions. I think here the idea is really to have a kind of digital toolbox. And what is a digital toolbox? Is to say either it can be a system, it can be some niche solutions, it can be some services provided by the bank, but you need to, in a basket, you need to put the various solutions you may use.
Yeah.
And then this in contemplation with your human resources. Say, what is the best fit? I think in 2019, our survey was saying that it takes two to tango, because in any case, solutions are not only in one system or not only in hiring more people, it's really both. It's really how you mix human and machine. And I think this is valid for every single topic. Yeah. Maybe one question for you, because I was really surprised by that, but I see that in the ACT survey, funding has disappeared for the top 5 priority. And I have to say, I was really expecting something else than that.
I completely agree with you. It was one of my first surprise when I saw the results. So we questioned something like 350 large multinational companies and head of treasury. And so I still don't know why funding was not higher ranked into the top 7, top 10 risk. Although we know that a lot of companies, for obvious reasons, were facing some problem. You know that some people were jumping on the credit facilities, withdrawing their credit facilities, some renegotiated new credit facilities, started to tap the market with no experience and in a very fast mode. I'm surprised it was not maybe highly ranked. And I don't know if you have an explanation for that.
Honestly speaking, I'm waiting to see our global survey to see whether this will confirm the trends or not. Yeah. If it would be the case, I may say maybe because the question has been asked to treasurer, and in terms of priority, they have the relationship with the banks, they know where they can draw down and so on. So maybe it's not a priority as such. While it's still a concern for CFO, maybe, or maybe because, due to the crisis, people have focused more on the short and medium terms. And so the funding somehow is, included in the liquidity management, but it's really hard to say. Now, that being said, I think this should be and is probably a topic for smaller entities. And we all know that, we can hear about the quantitative easing and the fact that the markets are full of cash and so on. But when you have a business and you need to go to the bank, you face some scarcity in liquidity because the banks are not really lending to everybody.
Although if we want to counterbalance, we could also admit that bank relationship was highly ranked and
exactly.
They value the benefit of a good bank relationship. And so it's just also a piece of advice we give always to our members. So do not neglect your bank relationship because when the crisis is coming, it's not the right time to start, maintaining your relationship. So it's quite important. So make sure that your bankers are also satisfied by the type of business you propose and you give them.
Exactly, and I think it's a very valid point. Mainly talking to entities who do not have a mature treasury, because we may be tempting by going to the bank which propose the cheaper rate, for instance. But I think in terms of wallet sharing, so how many fees will you pay to that bank or the others, considering the cost of funding is key. But if you have no tool, for instance, you might be ready to pay some basis point more and to have access to a white labeling TMS, which is a treasury management system. So it would allow you to generate some reporting, to have a better view on your cash positions, to enhance your control, and so on and so on. So I think banking relationship definitely is key, and maybe the funding have been.
And it's a fair point. So if you have better technology, you can produce better reports, better quality. What also it's good for banks. So I see the
exactly. It will decrease your cost of funding.
Of course,
totally. Yeah. So yes, indeed. I think we have those three recurring items, which are cash flow forecasting, risk management, and digitalization, but as a solution rather than a challenge. Now, next to that, we have also trending topic in big corporate words, if I may say so. And I think those topics are really of interest for smaller entities, or I would say other industries. So first one is Treasury on demand. Treasury on demand is really, I want to have the information right now. I think everybody may say, some people may say, okay, fine, I just would like to have a proper reporting before having it on demand. But when we see the evolution of e-commerce and the fact that with the crisis, everybody moved online, it's fair to consider directly whether solutions exist or not. Another one, which is one I like, is the eyeball replacement. So, the interbank rate, which is going to disappear and replaced by others. So this impact big corporates because it will create some value transfer on derivative, it will create ineffectiveness on hedging and so on. But I think even for smaller entity or less exposed entities, it means that the bank loans will need to be renegotiated. It means that delay clause in your contract need to be redrafted. So this is something not to forget. And obviously we have the KYC, which remains a burden, I think, for everybody. It takes a lot of time to open an account in the banks, and the procedure is really...
And solutions are emerging, and we talk very often, we address very often this topic at ATEL.
Exactly.
Transfer pricing, a big issue also for our member, because we have more and more, and especially after crisis, because of the huge indebtedness of states, we know that tax will be a real focus to recoup a maximum of tax to reduce the government deficit. So it's an interesting topic to
And by the way, IBOR has an impact on your transfer pricing documentation because you will need to update it. And so some jurisdiction might say, okay, that's fine, it's just an update. But some of them may say, guys, you've just canceled an agreement and put a new one in place. So you need to, to go through the full process one more time. So, and one more time, I think, this evidences the fact that Treasury is really dedicated to all, because nobody can say I'm not concerned by that.
Exactly.
So now, obviously, we have big corporates, we have small corporates, we have private equity structures and other type of structures. So every single treasury is unique, every situation is unique. What we try to do is somehow to put them in some bucket to see, where do you have to start, how can you evolve, and so on. So if we focus a bit on the treasury maturity curve, it's just a name because it's like a curve, but the idea is really to say, if we had to simplify a bit the various treasurers that we see, And if we were to talk to somebody who wants to set up a treasury, I would say, I mean, not rocket science, but start by fixing the basics. So usually what we say is start with a transactional treasury, where the main idea is execute properly the order, execute your payments, generate your cash report. Once you can do it effectively, and you have an enhanced internal control on your payments and your cash amounts and so on, then you can move to the next step, which is now becoming a process-efficient treasury. And in here, the idea is not only to execute, but to bring excellence in the execution, to start ensuring a kind of global vision on cash, not only the cash of the head office, to better manage liquidity management, to lowering the cost of the treasury as well. And then one more time, once this is done, then you can move to the next step, which is a value-enhancing treasury. And in here, I think the idea is really to bring quantifiable value to the business. You really help the business unit to decrease their cost. You really help negotiation with clients, with suppliers. You decrease your cost of funding. You increase your credit rating. And I would say the final stage, if I may say so, is becoming the real strategic partner, where the idea is not only to execute, but it's really to help in strategic decision, like you want to invest in emerging markets. You ask the treasurer, because how did you find some cash over there? How did you repatriate the trapped cash? You want to bring value to the shareholder, you can put in place some some share buyback program and so on and so on.
But I think it's really a key point. So it's a good piece of advice for our members. So try to assess your maturity, where you are, let's say, located on this yield, let's say, maturity curve. And then to see what will be your roadmap, what will be the next step, the next level.
Exactly.
Because you mentioned treasury on demand, to be able to produce what the demand you receive from the C-level. Real-time treasury, we also talk about real-time treasury because we realize that speed is an element. So if you want to react and you may need 3 days to produce a cash flow forecasting with the stress testing for the C-level, I guess that your CFO will be upset. So it's also a question of speed and reliability of information. And then we come back to the technology, how to get reliability through technology. Yeah.
Exactly. And I think this is, you say it's up to each treasury or each corporate, I would say, to assess this level. Of course, we can help, and I think the association can do it as well. The idea is, it's not only about your treasury as such, because treasury means a lot of things. So you may be super good in cash management, but really poor in terms of risk management. And so each angle needs to be analyzed in that perspective. I think just to give a few examples, and I don't know whether you can read on the slide because it's a bit too small, but in terms of cash management, if we just take the two extreme scenarios, we will have one where you start with absolutely no focus on cash, no forecasting, no KPI, nobody's reporting on the cash level. And at the very end of the cycle, when you super matter, you have an integrated platform that gives you on time, live, the position, the forecast per currency, and so on. So in between, obviously, you will start to set up a cash pool, and then you may enhance it with some payment factories and so on and so on. But the idea is really to see where you are, where you want to go, and where you want to go obviously depends on the business strategy, right? I think for risk management, we can give as well some example because...
No, but another good example to be pragmatic, and it's on your slide also. FX management, I'm always surprised. FX management, it's still very highly manual. And what we recommend to our members is to go for automation of FX processes where you can save time on repetitive operation and maybe dedicated that time to the strategic role or analytic role you mentioned.
I fully agree, but coming back to people who does nothing today, for instance, I think dreaming of having the risk management automated is absolutely fantastic. But the first key point is you have to understand where your risks are coming from. And I have to admit that today, talking to even some mature treasury, each time we touch base on FX, the very first step is really to go back to that and say, are you sure you know exactly where your risk is coming from? What creates the open position? Yeah. Exactly. Yeah. And one more time, you have tools that help you to do that.
It's also the beauty of the crisis. Let's see, positive point, if any. It's an opportunity to revamp, to revisit your processes and to see what can I do differently to improve, to be more resilient. And I'm sure that FX, I've noticed that some of our members have changed the strategy just because of the crisis. So, and there, coming back to the idea of value, FX is a good example, because if you start, let's say, hedging centrally, going into currency that you can offer to your counterparty, to your customer, to be paid in their local currency, you will open maybe new market. Of course, you need to manage the currency, but if it's automated, you can create value for the operation. And then I see a role that could be expanded for the corporate treasury, and maybe to become more strategic within the company, not only within finance.
And I think you touch on something really important here is, whatever you're talking about forecasting, FX risk management, which tool do we have to use? I think business partnering, treasury need really to partner with the business. Yeah. They need to communicate, they need to understand each other's, and this is the only way where treasury can really bring a solution as such and some added value. Yeah. By the way, and I think, by the way, that in the ACT survey, that notion of business partnering, strategic thinking is becoming, it's ranking higher and higher on the profile that is researched by Treasury.
We see that it's changing, and each crisis bring the next level. But I think that we realize that we can create value. And by the way, it's a fantastic opportunity offered to reposition Treasury. So. Again, positive aspect of this crisis, we realize that for any crisis the same, so that treasury becomes suddenly very important. So it's an opportunity to create value for other departments and to give evidence to the CFO that treasury it's a key asset. Because a lot of our members are always frustrated by the fact that treasury is not recognized as really a key department. Although, in my opinion, and I'm talking as a treasurer and Treasury Association, but for me it will be the most important department within finance.
I have to say I can agree with this. I have sympathy for that. But and I forgot what I just wanted to say. But I think there it is. I think you mentioned the crisis bring good things, and this is very valid for everybody. Is whatever or wherever you are on the maturity curve, I think it's really one more time. It's the time to build the case and to say, guys, we can do more.
Yeah.
So this is. Now I think, François, you mentioned as well a question at the very beginning of our discussion. You were saying, when do we have to hire a treasurer, or when do we have to really consider the function?
It's an excellent question. And usually when we have the treasury courses at ATEL, we receive the question from the student. Okay, but when do we have a sufficient size to justify a full-time job of treasurer? And then the next question, when do we have a sufficient, let's say, size or activities to justify a treasury management system? It's an interesting question, difficult to answer because we have example and counterexamples. So exactly. I cannot answer the question. I always say, okay, it depends. But when we have a certain degree of sophistication, what we have noticed that smaller companies start thinking, having discussion with a lot of SMEs, because we have also some SMEs in our member, realize that they start considering treasury. But then we have a first issue. As you say, they don't have a treasurer because they are too small, or they consider they are too small, and then don't have tools. And if you propose a tool, a cheaper tool with a new technology, but who will run my treasury? And if I have a treasurer without tools, okay, we come back to our famous Excel. So that's not a good situation. So you have a big gap between the heavyweight players, fully equipped with payment factory, treasury management system, etc., and a team, a dedicated team of a couple of persons, and the other with no treasurer and no TMS. So we have a big gap, and that we come to the first initial question. Okay, is it for all? Yes, it's for all, but I have the impression that sometimes people don't dare to enter into the treasury. So it seems to be mysterious, and maybe we should demystify.
Yeah, but I think, the question can be asked for every single job in a firm. And what I like to say here is, when you set up a company, treasury needs to be considered. I mean, it's here since the very first day. Your business plan is based on cash movement, not on accounting. Yeah. So treasury needs to be considered since the very first day. And then obviously, the more you will grow, the more you will need to spend time on treasury, because treasury is just, I need to have the right amount of cash at the right time, at the right place, in the right currency. So when you start your company, somehow it's easy. When you have 10,000 employees and 20 subsidiaries, it becomes more complex. But in between, the more time you will need to spend on how you manage that cash, really broadly speaking. The more you will tend to a situation where either you will have a tool, either you will hire someone, either you will do both, because it's always the right mix, man and machine. So I think like you do with your accounting, I mean, when you start a business, accounting is outsourced. You don't do your reporting. 10 years later, you have an accounting team. And in between, at a certain point in time, you had to do it yourself. And I think for Treasury is really the same. This is the blood of the entity.
But every company has an accounting department. Not every company has a treasury department.
Which for me is surprising.
And accounting and maybe it's more important, an accountant are doing treasury or CFO without daring to say that they manage treasury.
Exactly. It's like they know it's important, but something is refraining them from really doing it properly.
Yeah.
And one more time, that story with the 6 token for me is just amazing as of today.
So how could you automate processes? Because we also know that those who are still using manual payment partly or electronic banking system need to try to interface, because it could save time, reduce the risk of error, the risk of fraud, because we also see during this pandemic a significant increase, I guess you will confirm, of fraud cases, so due to the home working. So it's another additional reason to reconsider your system and to automate. And in the future, I won't be surprised if some banks stop working with some customer or onboarding customers if they are not fully digitalized. So we should certainly improve the level of digitalization across different treasury and across companies.
Yeah, exactly. And I mean, somehow Treasury is, it's something which is evolving with the business. So if you're considering since the very beginning, you will naturally involve in your Treasury competencies as well. Yeah. So, and I think maybe we can conclude on that, because the question was, was it for everybody? I think the answer is obviously everybody faces the same Treasury issues. I think the answer will depend on your size, your maturity, and so on.
Okay, thanks, Philippe. And just to conclude, so yes, indeed, we answer the question. So Treasury is for all type of company, all type of organization, not only the corporate. So thanks a lot for attending this session. I hope you enjoy it. Thanks, Philippe, for your participation.
You're more than welcome. Thanks to you.
Cheers.
Cheers.
Thanks, Philippe, and thanks to all speakers for these insightful presentations and comments. I hope you like it as we did. Have a nice evening, a nice, relaxing summer holiday, and I see you in early October for ATEL's annual conferences, again in a hybrid mode. Take care.